Welcome, students. My name is Professor Minh, and welcome to our class, Act Right 101. And today's topic is everything you need to know about your mortgage payment. I'm kidding, guys. I'm kidding. But I wish in high school someone would have taught us on how to calculate your mortgage payment instead of me taking teacher aid classes or attendance monitoring classes. If there was an Act Right 101 that prepared me for life, I would have taken it. And I wish they would teach how to calculate your mortgage payment. What's going on, guys? My name is Minh with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. If it's your first time tuning in, do me a huge favor. Hit the subscribe or notification button so you're notified every time we go live or post new content. We go live every Monday night at 9 p.m. and we post content daily on Instagram and TikTok. So guys, let's get into it, right? Everything you need to know about your mortgage payment. So there's two things you got to know before you start busting out that mortgage calculator. Number one, you got to know what's included in your mortgage payment. A lot of mortgage calculators out there don't have the complete payment. You get excited, you fall in love with the house, and once you get the rest of the items, the payment is too high. So you got to know what's included in your mortgage payment. It also helps you with your debt to income ratio. If you haven't seen our video on debt to income ratio yet, go ahead and check it out on our YouTube channel. Definitely, it will show you how to budget for a mortgage payment. First, what's included in your mortgage payment? Because a lot of mortgage calculators are missing some things. So this is what's included in your mortgage payment. Your principal and interest payment, your homeowner/hazard insurance, there is a difference, private mortgage insurance, and your property taxes. So these are the main items included in your mortgage payment. If you're using a mortgage calculator and you don't see these four items, make sure you add them. So let's talk about your principal and interest. When you make a standard mortgage payment, of course, there's something called home equity line of credit and interest only loans, but tonight we're talking about your standard mortgage payment. When you make a payment, if you borrow money, you're typically paying back the principal and the interest. And they've calculated the formula on how much you need to pay back the principal and interest with a steady pace. And they do it through amortization. So there is a formula that banks have put together, and they front load all the interest because they want all their money first because they're taking on all the risk and loaning you that money, and they amortize it either over 30 years, which is your standard loan, 25 years, 20 years, or 15 years. But you can get crazy too. You can do a 22-year fixed loan. You can do a 21-year fixed loan. You can do a 17-year fixed loan. You can decide the amortization. Especially if it's your second or third home, you feel like you don't want to do another 30-year fix, you can do a shorter term. You're coming in with tons of equity. Or if you had a home and you've had that loan for over 10 years, you might not want to go back to a 30-year fix. You can refinance on a 20-year fix. Let's say you've had the home for 12 years, right? You can do an 18-year fix. There's a lot you can do, but you want to see when you make your payment, what goes towards principal and what goes towards interest. So that's why it's important that you know how to calculate your principal and interest. So here's an example. So let's say on a $500,000 loan with a 5% interest, rates are not at 5% as you're watching this right now in October 2021. This is just an example. On a 30-year fix, on a $500,000 loan amount, the payment's going to be $2,684. In 30 years, you will pay back the $500,000 in principal plus $466,000 in interest. But let's say you go with a 25-year fix. Your payment would be $2,922, but you're paying back $376,000. A 20-year fix, about $3,300. You pay back $291. On a 15-year fix, you'd pay back about $3,953 and pay back $211,000 in interest. Remember, the shorter the term, the higher the payment, but the lower the interest as well. Like I said, mortgage payments is not for the faint-hearted, so a lot of people do go with the 30-year fix first. But if they're used to a mortgage payment, or like I said, they're selling and upgrading, or they're refinancing and they don't want to go back to 30 years because they care about a lower payment, but they're not trying to stretch it back out, they normally go with a shorter term loan. So now that we know that there's principal and interest, the next factor in your mortgage payment is your hazard insurance. So hazard insurance is mandatory if you are financing the property. Unless you're getting a condo, then in the condo, it's covered. But if you are buying a single family home, a townhouse, a duplex, triplex, or fourplex, there will be hazard insurance if you finance it. and it's there to cover any damages in the house from natural disaster. Hazard insurance is there to protect the lender. When you buy a home, there's standard hazard insurance. Unless you're trying to go for the Rari. The Ferrari version is homeowners insurance. People didn't know there was, I learned it as well. It's different. You can get basic hazard insurance or you can get homeowners insurance, which includes hazard insurance, plus protects you from various types of damages such as theft, any medical bills from any injuries that someone got hurt on your property or in your property. The homeowners insurance protects the lender and protects you from any incidents. Typically, when you get hazard insurance, you're going to pay 1 year up front. And then if your account is impounded, that means you make your mortgage payment with your tax insurance. They collect your hazard insurance and they pay it the following year. But if your account is not impounded, they typically will pay 1 year up front. And then the following year, they will send you a bill for hazard insurance. That's a second main factor included in your mortgage payment. The third one, which is not optional, if you are putting less than 20% down on a conventional loan or you're going with an FHA loan, there's private mortgage insurance. So, what is private mortgage insurance? People ask me all the time. That insurance is there to protect the lender. If you were loaning out money and someone didn't come in with a lot of collateral, with a low down payment, it protects the lender in case you can't make your mortgage payment and they gotta foreclose. And there's not enough equity when they foreclose, that insurance pays them back any losses. So when you are going with an FHA loan, there is upfront mortgage insurance and there's monthly mortgage insurance. You cannot get around that. And if you're going with a conventional loan, there's 4 types of PMI. There's monthly, which we'll talk about later. There's single premium, which means instead of paying it monthly, you pay a lump sum upfront. And it doesn't matter if prices go up or down, you won't have private mortgage insurance. And the third way is split, which means it's a blend of a little bit of monthly and a little bit upfront. And the fourth type of private mortgage insurance is lender paid. So don't get all excited going, oh my gosh, I talked to this one lender, I'm doing less than 20% down, but they don't have private mortgage insurance. But guess what? It's rolled in the interest rate. So typically you will take a higher interest rate to cover the private mortgage insurance. Now that's the third factor included in a mortgage payment. Of course, if you do 20% down on a conventional loan, you will not have it. Now the next factor is your property taxes, the fourth factor in your mortgage payment. We went over principal and interest, hazard insurance, private mortgage insurance. The next one is property taxes. It is a cost of owning land in a specific state. It's the one bill that will not go away. Every city has a different tax rate. The county assessor will assess it at purchase price. If you want to know what your county tax rate is, definitely call your your city tax rate is, call your county and tell them the cities that you're looking to buy in and get the city tax rate. And remember, every state differs on how they reassess the property. If you buy a home, like for example, in the state of California where I'm from, if you buy a home, you're protected under Prop 13, which means they can only reassess your property 2% a year. But if you change the name of the people on title, they will go out and reassess it at the new value. For example, you bought a home, 10 years later, you add your cousin or you add somebody. They're going to reassess it with the value 10 years later, which can drive up the property taxes. Also, if you do any home improvement that requires permits, it's like a catch-22. You live in your house, you plan on living in it for a long period of time, you add a pool, you add square footage, right? You go out and get permits 15 years later. If you go out at 15 years later, it's not the price you bought it at. They reassess it at the value 15 years later. I see a lot of people when they inherit the property from their parent or grandparent, right? They got the lower property taxes, they're excited, but since the home has tons of equity, they go out and they do upgrades. If you do any upgrades that require permits, beep, it will bring up your monthly property taxes. So those are 4 main factors that are included in your mortgage payment. You got your principal and interest, you got your hazard insurance, you got your PMI, you got your property taxes, and I forgot the 5th, homeowners insurance. HOA. There's some HOAs in this house. Homeowners Association, right? HOA. If you are buying a home in a community, there is HOA. If you're buying a condo, there will be HOA. I see people forget to tell their lender or they're trying to calculate their mortgage payment and there's no HOA section. Remember to include your HOA. If you don't include your HOA, your DTI will skyrocket. I see people qualify to buy a home, right, Rosalinda? You laughing now, girl, right? And you don't include that HOA. and that HOA drives up your DTI, you can knock yourself out from qualifying. Some people qualify to buy a home, all of a sudden they get excited, but then they go out and they fall in love with some condo, and that condo has a HOA. You find out that monthly HOA payment, and that monthly HOA payment is a little too high. Guess what? You just drove up your DTI. It could knock you out from qualifying. You might have to come in with a bigger down payment, pay off some debt, or add a cosigner, because that HOA bill is expensive. Homeowners Association is part of your mortgage budget. When you're trying to calculate your DTI, don't forget it. Even though when you make your mortgage payment, it doesn't include the HOA payment. It's a separate bill, but you gotta count it. So those are the items that make up your mortgage payment. If you found this video useful, do me a huge favor. Save this video, share this video, and like this video. And also, if you're not following us by now, please hit the subscribe and notification button so you're notified every time we post new content, right? I'm laughing because Rosalinda's laughing right now. Guys, if you do need to get a hold of me, here's a number, 714-790-9697. Give us a call or text us. If you have a loan estimate, you want us to help you read it or beat it, send it to info@whatsamortgage.com. All right, and we'll help you review it. If you just need help reading it, send it over. But if you want us like just beat it, right, tell us, and we will find someone out there that will beat it for you. All right, guys? Guys, we want to end all our episodes with our attitude is gratitude. Without you, there would be no us. So thank you guys so much and have a great night.